Hello, this is the 41st episode of What Would Peter Lynch Do, which explores the wisdom of legendary investor Peter Lynch. Today, we're diving into a question that comes up a lot, actually. A listener asked, when investing in stocks, some say you should have a cash holding to prepare for a market downturn, while others say you should just buy stocks with all your monthly cash because the market is unpredictable. What should I do about my strategy for cash holdings? And that really gets right to it, doesn't it? It's something many of us think about, especially if you're newer to investing. You hear this idea, time in the market beats timing the market. Just stay invested. Sounds simple. But then you also see giants like Warren Buffett, right? Often sitting on huge piles of cash, waiting. Both sides sound plausible, which makes it, a bit tricky to figure out.
It really is a puzzle, and maybe the first thing to get clear on is that there isn't one single right answer here. How much cash you should hold, well, it's not some fixed number you just set and forget. It changes. It depends on the market, on your own style, your own situation. Cash isn't just zero. It can be a really strategic tool, for stability, but also for grabbing opportunities later on. So our goal today is really to help you create your own cash management rules.
Okay, great. Let's start with that first idea then, the fully invested strategy. Believing in the power of time. Just put all your money in the market and keep it there. What are the numbers behind that? Why is that idea so powerful?
Well, the biggest reason is something called cash drag. It's basically the opportunity cost, right? Your money sitting on the sidelines, not growing while the market might be going up. That's cash drag. Charles Schwab did this really interesting study. They tracked 5 made-up investors over 20 years. Each put in $2,000 a year. So you had Peter Perfect. He somehow managed to invest at the absolute market low every single year. Unreal timing. He ended up with about $186,000.
Okay, the perfect timer. Got it.
Then there was Ashley Action. She didn't try to time anything, just invested her money right away, beginning of each year. She got around $170,000. Not bad at all. But here's the kicker. Rosie Rotten. She had the worst possible timing. Invested at the market peak every single year.
Oh, wow. Okay, so she bought high every time.
Every single time. And she still ended up with almost $151,000.
Wait, seriously, even buying at the peak consistently, she still did that well.
Exactly. And compare that to Larry Linger. He just kept his money in cash equivalents like T-bills, never bought stocks. Larry ended up with only about $51,000.
Okay, that difference is huge.
It's massive. So the point is, even with terrible timing, just being invested long-term crushed sitting in cash. The penalty for missing out, that cash drag, it's just enormous over time. And Vanguard found something similar. If you had a standard 60-40 portfolio, just missing the 25 best market days, your final amount dropped by 60%.
60%, just from missing a few good days.
Yeah. The best days often come right after the worst days, surprisingly. It shows the biggest risk maybe isn't the downturn itself. It's being out of the market when that unpredictable upturn happens.
That really drives home how hard prediction must be. You have to be right twice, like you said before. When to sell, and then crucially, when to buy back in. That sounds almost impossible.
It pretty much is, for most people anyway. Your sources mention a wisdom tree analysis looking at 16 expert forecasts for the S&P 500 in 2023. The actual growth was over 24%. Not a single expert got close. The average miss was like 21%.
So even the pros get it wrong, often wildly wrong.
Right. And think about it. Nobel laureate William Sharpe figured out a market timer needs to be right 74% of the time just to match the market, just to break even with a simple index fund. So why do we think we can beat that? Plus, there's this clustering of returns. The best days and the worst days, they tend to happen close together, especially in scary bear markets. Volatility is way higher then. Like daily swings can be huge, plus 11%, minus 12%, much bigger than in bull markets. So if you sell to avoid the bad days, you're super likely to miss the really good days that often follow right after. You lock in losses.
Okay, so the takeaway from this side is clear. Trying to time the market is usually a losing game. The real risk is being on the sidelines. Just get in, stay in. All right, but let's flip the coin now, because there's this other approach, the strategic cash idea. And yeah, Warren Buffett is the name that always comes up. He often holds a lot of cash. Why does he do that? What's the thinking there?
Well, his famous line sums it up right. Be fearful when others are greedy, and greedy when others are fearful. But it's not really about predicting where the market's going next week or next month. It's about reacting to valuation and sentiment. He builds up cash when things look expensive, when everyone else is maybe getting too excited, too greedy. Right now, Berkshire Hathaway holds something like over $325 billion in cash and short-term treasuries.
$300 billion.
Yeah, it's about 30% of their assets, the highest it's been in like 30 years. And Buffett says himself, it's not because he thinks a crash is imminent, it's because he just can't find big companies. Elephants, he calls them, worth buying at a price he thinks is reasonable.
So it's driven by a lack of good deals, not a forecast.
Yeah.
How does he judge if things are expensive?
He looks at objective data. One tool mentioned in your sources is the Buffett indicator. It's basically a comparison of the total value of all stocks, the market cap, compared to the country's economy, the GDP. Right now, that indicator is around 209%, which is really high. Way higher than even the dot-com bubble peak back in 2000, which was about 140%.
Okay, so that's a signal to him that maybe things are overheated.
Exactly. So when that indicator is high, he tends to let cash build up. When it's lower, signaling better value, that's when he tends to deploy it. It's discipline based on price.
And we've seen him deploy it brilliantly, right? Like during the 2008 financial crisis? That's legendary.
Oh, absolutely. While everyone else was panicking in 2008, Buffett went shopping. He invested about $25 billion in top companies like Goldman Sachs, GE, when they were desperate for capital. And he made nearly $10 billion profit on those deals in just 5 years. That's like a 40% return.
Incredible.
His cash became massive bargaining power precisely when fear was highest. He was being greedy when others were terrified. And there's another angle now, too. Your sources call it the era where waiting pays off. Right now, short-term U.S. Treasury yields are pretty high, over 4 or 5%.
Right, you can actually earn decent interest on cash now.
Exactly. So Buffett's company is earning billions in interest, just letting that cash sit there. It's not a zero return asset anymore. It's like getting paid to be patient. So again, his cash isn't just a waiting for the crash fund. It's more a result of not finding value, and now that waiting actually earns something.
Okay, that makes a lot of sense. Patience and readiness, not prediction. But even with clear strategies like Buffett's or the stay invested approach, we humans get in the way. It feels like, the biggest enemy in investing really is yourself. Our emotions trip us up.
That's so true. Your sources really nail this. Our own psychology is often our worst enemy. There's loss aversion. Basically, losing $1,000 hurts about twice as much as gaining $1,000 feels good.
I can feel that.
Right. So what happens? People panic sell when the market tanks, locking in losses because the pain is too much. Or the flip side, they hold on to losing stocks way too long, just hoping to get back to even because actually realizing the loss hurts too much.
Yeah, I just needed to get back to what I paid trap.
Totally. And then there's the opposite emotion. That anxiety when everyone else seems to be making money and you're not.
Oh, yeah. FOMO, the fear of missing out, that's powerful.
It really is. And it leads to herding behavior. You see everyone piling into something, maybe tech stocks or crypto, and you jump in too, often right near the top, just when maybe you should be cautious, like Buffett. So you end up getting burned at the peak. And then there's just unfounded confidence. Believing we're better predictors than we are. That's overconfidence bias. Or looking back after something happened and thinking, oh, I knew that was going to happen. That's hindsight bias.
Right. Makes you think you can time the market next time.
Exactly. Which, as we saw, is usually futile. Leads to too much trading, racking up fees, making mistakes. So the big takeaway here is, willpower isn't enough. You can't just decide not to be fearful or greedy in the moment. The solution, the only reliable one really, is to create rules. A system. Before the crisis hits, before the euphoria hits, like dollar cost averaging or automatic rebalancing or having specific rules for when you'll deploy cash if the market drops, that system makes the rational decision for you.
Build the system, trust the system. Got it. But okay, we also talked about how the environment changes.
Yeah.
The value of cash itself isn't fixed, right? It changes with the economy.
Absolutely. That's another crucial layer from your research. Your cash strategy can't be static because the economic backdrop changes. Think about interest rates and inflation. Remember the ZRP era, zero interest rate policy, roughly 2009 to 2021. Interest rates were near zero. Holding cash back then meant you were actively losing purchasing power because inflation was still happening even if low, and your cash earned nothing.
Right. Cash felt like trash then.
Pretty much. It led to Tina, there is no alternative. People felt forced into riskier assets, stocks, real estate, whatever, just to get some kind of return. The fully invested idea felt really urgent then.
Okay, and now?
Now we're in this high-interest era since 2022 or so. Central banks hiked rates. Suddenly, safe stuff, cash, short-term treasuries, they offer decent yields. 4%, 5%, maybe more.
So waiting pays off, like you said with Buffett.
Right. There's less pressure to jump into potentially expensive stocks immediately. You actually get rewarded a bit for being patient with cash. But you always have to watch inflation. It's the silent thief, right? eroding what your money can buy over time. Even if you earn 5% interest, if inflation is 6%, your real rate of return is negative. You're losing buying power.
Ah, okay, so you still need growth over the long term.
Exactly, which is why long-term you generally need assets like stocks that have the potential to grow faster than inflation. So the opportunity cost of holding cash, it's not fixed. It moves around depending on rates and inflation. You need to be flexible.
Okay, this is making sense. We've got the stay invested argument, the strategic cash argument, the psychology traps, the changing economy. So how do we put this all together? For someone listening maybe new to this, how do you actually divide your money? Let's talk about this 3 money jar strategy.
Yeah, this is where we try to make it really practical. It uses a psychological trick called mental accounting in a good way. Instead of one big pot of money, you mentally divide it into 3 jars, each with a very specific job. Helps with discipline.
Okay, jar number 1.
Jar 1 is your emergency fund. This is sacred ground, money you absolutely do not invest. Its job is to handle life's unexpected curveballs, job loss, medical bills, car repairs, whatever. Crucially, it stops you from having to sell your investments at a bad time just because you need cash now.
Right, protects your long-term plan. How much?
Standard advice is 3 to 6 months worth of essential living expenses. Keep it somewhere super safe and easy to access, like a high-yield savings account, not in the market.
Okay, jar 1, emergencies only. Got it. Jar 2.
Jar 2 is your opportunity-seizing ammo. This is your strategic cash reserve, like Buffett's pile, but scaled to you. Its job is to be ready to scoop up stocks when the market takes a significant dip, when things go on sale. How much goes in here? Well, it really depends on you. Your age, your risk tolerance, maybe 5–10% of your investment money if you're young and aggressive. Could be 20–30% or more if you're closer to retirement and more conservative. The 100-year age rule can be a rough guide for your overall stock allocation, which helps figure this out too.
Okay, so it's personal. And how do you manage it?
The smart way is to adjust it based on market conditions. When the market seems expensive, maybe using something like the Shiller PE ratio as a guide, you let this jar fill up more. When the market looks cheap after a drop, you use the money in this jar to buy. It helps you automatically buy low.
Ah, like automating the Buffett approach a bit.
Okay.
And jar 3?
Jar 3 is your core investment pot. This is everything else. All the money left after you've filled jar 1 and jar 2. This money is for your long-term goals. It should always be invested, working for you. Diversified across different assets, maybe different countries. This is your main engine for growth.
That's a really clear framework. Emergency, opportunity, and core growth. Makes total sense. Your sources had a table, didn't they? Showing examples, like a 20-something might have 5% emergency, maybe 10% ammo, 85% core, and a 50-something more conservative might have 5% emergency, 25% ammo, 70% core. Something like that.
Exactly. Those are just examples guides. But it gives you a starting point for your own investment compass. It helps you stay the course.
Okay, super practical. Now even more practical. Where do you physically keep the cash for jar 1 and jar 2? And how exactly do you pull the trigger on using that jar 2 ammo?
Good questions. For jar 1, the emergency fund safety and accessibility are key. So, like we said, a high-interest savings account or maybe an MMDA, money market deposit account, at a bank, usually FDIC insured. For jar 2, the ammo pot, you still want it safe and fairly accessible, but maybe you can reach for a little more yield. Options include money market funds, MMFs, at a brokerage, usually higher yield but typically no deposit insurance, or maybe a brokerage CMA cash management account for convenience. Some people might even use a short-term bond ETF for potentially higher yield, but you accept a little bit of price fluctuation there. It's a trade-off.
Okay, so options depending on your comfort level.
Yep.
And using the ammo, how do you avoid freezing up or jumping too soon?
Rules. Predefined rules are everything here. Takes the emotion out. Your sources gave an example. Maybe rule 1 is market drops 20% from its high. Deploy 1/3 of your jar 2 ammo. Rule 2, market drops 30%. Deploy another third. Rule 3, market drops 40%. Deploy the rest. You just follow the plan.
Okay, a step-by-step deployment based on the drop.
Or another idea is using the VIX index, the fear gauge. Maybe you decide to buy a chunk every time the VIX spikes above, say, 30 or 35, indicating high fear. The specific rule isn't as important as just having one you'll stick to.
Makes sense. And then how do you refill jar 2 after you've used the ammo?
Couple of ways. You can add new money over time, like from your paycheck savings. You could also set your dividends to collect as cash in jar 2 instead of automatically reinvesting them. Builds it up slowly. But probably the most powerful way is through rebalancing your core pot, jar 3.
Ah, how does that work?
Let's say your target is 70% stocks, 30% bonds cash, including jar 2. If stocks do really well, maybe they grow to 80% of your portfolio. Rebalancing means you sell 10% of those appreciated stocks to get back to your 70% target. Where does that cash go? Straight into jar 2, refilling your ammo. It automatically makes you sell high and builds your cash to buy low later. It's brilliant.
Wow, okay. So rebalancing isn't just about risk control. It's also about reloading your opportunity fund. That's clever. So really, the best approach isn't picking either all-in or a strategic cash. It's combining them. You have that core pot, jar 3, that's always invested working long-term. You have jar 2, the ammo pot, that's patiently waiting for those big opportunities.
That's exactly it. The 3 money jar strategy is about building that robust portfolio, yes, but it's just as much about building a robust mindset. It helps you turn market fear, which paralyzes most people, into your ally, into an opportunity, because you have a plan and the cash ready. You're prepared, not predicting.
That's a fantastic way to frame it. Prepared, not predicting. Love that. And that brings us nicely to our closing quote from Peter Lynch today. The real key to making money in stocks is not to get scared out of them. It really echoes everything we've discussed, doesn't it? Having that system, those jars, that ammo, it's all designed to help you stay the course, to not get scared out when things look rough. And that principle, it applies beyond investing too, right? Sticking to a plan, not letting fear derail your goals, whether in finance or just life. It's powerful wisdom. See you next time. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.